Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. The Institutional Briefing, Market Volatility, and Tech Earnings Rotation. This video presents a direct informational narration of the source document. Today, we're unpacking a massive briefing covering macro trends, zooming in on semiconductor and memory sector earnings, checking out the hardware and network divergence, and looking at some alternative tech and software.
Okay, let's dive into this. Section 1, Macro Trends and Volatility. Interestingly, the source document starts off by noting the ongoing Paris heatwave, but then it immediately pivots to something that is rapidly cooling down, specifically the United States consumer and producer price indices.
Here are the exact numbers we're looking at. The U.S. July Producer Price Index, or PPI, fell to 4.7% year over year, and it stayed totally flat month over month. Meanwhile, the core PPI dropped to 4.2%. Why does this matter? Well, this widespread cooling essentially suppresses the transmission of upstream inflation hitting the consumer end later down the line. It's exactly the kind of data that heavily reinforces market expectations of the Federal Reserve either holding steady or outright easing rates in September.
And this brilliantly illustrates a fascinating structural divergence setting up right now. After days of sideways consolidation, the S&P 500 surged, hitting a record intraday high of 7,816 before closing just below 7,800. But look at this. The VIX Volatility Index rose at the exact same time. Normally, in a standard uptrend, the VIX drops when the broader index rises. The fact that both went up simultaneously signals widening, multi-directional market friction.
So we have some major volatility catalysts right around the corner. Next Wednesday is the VIX futures settlement, and that's followed by the monthly options settlement next Friday. Because volatility has been artificially suppressed, the mechanical buying during these upcoming settlement windows could instantly amplify market oscillations. The strict advice here is to really manage those moving take profit and stop loss levels. Moving into Section 2, Semiconductor Equipment Earnings, let's shift into the bottom-up micro-analysis of this highly contested space. So the crucial point is found right here in Applied Materials, or AMAT. They posted Q3 revenue of $9.12 billion, which is up 25% year over year. Net income soared 43% to $2.54 billion, and gross margins expanded to 50.3%. They even gave robust fundamental guidance for 2026. But despite those stellar numbers, the stock remains locked in a really critical technical battle right at its 50-day moving average. Then we have Cerebras, or CBRS. Total Q2 revenue jumped 74% year over year to $180 million. But you have to look under the hood here. Hardware revenue actually dropped 23%, down to $54.10 million, while cloud and services skyrocketed 280% to $126 million. The analysis notes that their shift from being an NVIDIA hardware challenger to a cloud computing revenue model totally disrupts its valuation metrics, and that's what prompted the heavy Wall Street sell-offs. Finally, look at Coherent, or COHR. They beat expectations completely. Revenue grew 34%, EPS surged 74%, and gross margins topped 40%. Yet, the stock fell about 8%. It was purely due to overcrowded trades and short-term profit-taking in the optics sector once the results dropped. This brings us to Section 3, Memory Sector Capital Rotation. Let's see how capital is heavily favoring memory and storage. SNDK laid out a huge long-term financial model at their investor day that drove a 3% surge. They're targeting mid to high double-digit revenue growth for fiscal years 2028 through 2030, with a gross margin target of about 80%. More importantly, they have long-term agreements with 8 major clients covering 50% of their fiscal 2027 bit shipments and roughly 66% of their fiscal 2028 bit shipments. These agreements stabilize cash flow and mitigate the traditional cyclicality of the business. To show exactly how concentrated this rotation is, 16.09% represents the concentration of JP Morgan's top 5 Q2 holdings. Their explicit top buys driving this are Micron Technology, AMD, LR6, Google, and Class A shares. Looking at Micron specifically, we saw a 7% intraday surge that subsequently closed below the 50-day moving average. Underscoring this, sustaining the 10-day moving average is the absolute critical threshold for maintaining its uptrend right now. Let's move to Section 4 and see how this builds into the contrasting post-earnings reactions within the legacy hardware and networking sectors. Cisco actually posted robust numbers. Q3 revenue of $17.3 billion, up 18% year over year, and adjusted EPS of $1.22, up 23%. They even guided full-year revenue about 6% above estimates. But the stock dropped over 8% from historic highs. Why? Because the market was severely disappointed by their current year AI revenue of just $400 million, alongside a 2027 AI revenue target of only $7.5 billion. Contrasting that entirely, Dell Technologies surged nearly 10%, remaining steady at its highs, and is up roughly 3 times this year alone. While broader semiconductor peers suffered brutal 40 to 50% declines in July, capital heavily rotated into Dell as a proxy alternative to SMCI, purely due to the ongoing regulatory and financial concerns surrounding SMCI. Moving into Section 5, Software and Alternative Tech, let's get into the final technical breakdowns. For AppLovin or APP, after a recent low of $303, the critical support zone is right between $295 and $300. Short-term resistance sits at $325 near the 5-day moving average, with a secondary resistance up at the $345 to $350 gap fill area. It's dealing with a persistent downtrend and heavy overhead supply, which are required levels to clear for any structural bottoming or gap fill recovery. Now, what's really interesting about this slide is the data on SpaceX short interest. We've seen a massive depletion, dropping from a previous peak of about 34% down to just 11%. This effectively removes the necessary fuel for a short squeeze, directly resulting in the current price stagnation.